Okay, let's unpack this. When you hear budget, your mind might immediately conjure images of endless spreadsheets, dry numbers, and perhaps a feeling of strict, unbending rules. It often sounds like the least thrilling part of business, right? But what if I told you budgeting is actually the strategic heartbeat of any organization? It's the critical bridge that takes grand visions, bold strategic plans, and transforms them into tangible, measurable reality. Think of it as decoding a company's financial DNA, understanding its blueprint, its pulse, and how it plans for growth and resilience. It's a shortcut to truly understanding how a company breathes and operates, often with surprising insights that keep you completely hooked.
Yeah, and what's truly fascinating here is that budgeting transcends mere numbers. It's the ultimate tool for translating a company's entire vision into tangible action. It's precisely where abstract strategy meets the concrete reality of execution, turning ambitious goals into actionable, measurable steps.
That's the perfect way to put it. And in this deep dive, our mission is for you to walk away with a robust, intuitive understanding of how organizations plan their financial future. We'll journey through everything from the high-level policies and standards that lay the groundwork to the different types of budgets that make up the whole picture. We'll look at their practical application through compelling scenarios and even explore how these plans can adapt to the unpredictable nature of the real world. Get ready for some serious aha moments and actionable insights into what might seem like a complex process but is actually deeply logical and empowering. So let's kick things off with the fundamental why. Why do organizations dedicate so much effort to budgeting? It's not just, as I said, about counting pennies or cutting costs. Its primary purpose is to execute those grand strategic plans. Imagine a master architect designing a soaring skyscraper. They don't just sketch a beautiful building, they have to meticulously figure out how to actually construct it, beam by beam, floor by floor, down to the last bolt. That's precisely where operational and tactical planning come into play within a business. This is the precise process of determining specific, actionable objectives and the practical means by which those ambitious strategic plans will actually be achieved. It's taking that soaring, big picture vision and breaking it down into manageable, actionable steps that everyone can understand and work towards.
And that's a critical distinction. These tactical plans, often referred to as single-use plans, are typically short-term, generally covering periods up to about 18 months, let's say. The quintessential example, and one we'll focus heavily on today, is the annual budget. This budget isn't just a financial document. It's a critical type of single-use tactical plan. It directly translates the overarching strategic plan into a detailed, period-specific operational guide. This translation is vital because it places the responsibility for achieving those strategic goals directly into the hands of managers across the organization. This isn't just about handing out orders. It's about decentralizing that strategic responsibility, empowering every manager to make strategy a routine, integral part of their job function. It ensures that the overall vision isn't just talked about in boardrooms, but is actively accomplished at every level, making everyone a direct participant in the company's future.
Right, I can see how decentralizing that responsibility makes strategy a daily reality for managers. You could have the most brilliant strategic vision in the world, but if you don't have a concrete plan with budgets to execute it, it remains a beautiful idea on a whiteboard gathering dust. But for this execution to happen smoothly, you need some solid ground rules. And that brings us to the essential budget policies. It's like building that skyscraper. You need a solid foundation and a clear blueprint before you even think about laying bricks. So it's crucial to understand that effective budgeting needs formal rules and, absolutely crucially, broad involvement. A typical budget usually extends for about 1 year, and it involves a significant number of people across various departments.
Precisely. To ensure effective budgeting, an organization truly needs to implement formal budget policies that include some key features. First, there's robust management participation. Because a budget impacts so many individuals and departments over its typical 1-year span, the process normally involves a dedicated budget committee. This isn't a mere formality. This committee is genuinely charged with resolving any disputes that inevitably arise during the budgeting process, and, critically, making the final decisions regarding major budget changes. This ensures that diverse departmental needs and viewpoints are thoroughly considered and reconciled. Second, and equally important, are clear budget guidelines. Top management, the strategic leaders of the entity, must provide clear, overarching guidelines for budget preparation. These aren't arbitrary rules. They're deeply rooted in the entity's strategic goals and its long-term plan. These guidelines are comprehensive. They should include an evaluation of current conditions, like the results achieved to date, and the specific goals set for the upcoming period, along with any specific management directives related to how budgets should be constructed or what priorities they should reflect. What this highlights for you, the listener, is just how crucial clear communication and a well-defined structure are. Even before any numbers are actually put down on paper, it's all about ensuring alignment from the top leadership all the way down through every layer of the organization, making sure everyone is rowing in the same direction from day one.
Okay, so with those strategic foundations and overarching policies firmly in place, the next crucial step in budgeting often involves setting benchmarks or targets. And that brings us directly to the powerful concept of standards within budgeting. Think of standards almost like the bullseye you're aiming for, the ideal measure of what something should cost or how efficient a process should be. We're talking about a per unit budget. This means, for instance, what's the standard cost of raw materials for 1 unit of product, or the standard labor hours for 1 unit? These standards are incredibly important because they become integral to developing something called flexible budgets, which we'll explore in detail later. But for now, here's where it gets really interesting. Standards are like the gold standard, or the ideal target for what things should cost or how efficient things should be. They give you that critical yardstick to measure against.
Indeed. And when we unpack these standards, we discover there are two primary types, each with its own significant psychological impact on employees and its own set of advantages and disadvantages. It's a fascinating dilemma of motivation. Generally, standards are often intentionally set somewhat below perfect expectations to motivate productivity and efficiency. However, it's absolutely critical that these standard costs are revised periodically, typically at least once a year, to reflect any changes in previously determined conditions, ensuring they remain relevant and fair, not just arbitrary targets. Now let's look at the first type, ideal standards. These represent the costs that would result from perfect efficiency and effectiveness in job performance. When you set an ideal standard, no provision is made for normal spoilage of materials, no typical downtime of machinery, no human error. It's a flawless best-case scenario. The primary advantage of using ideal standards is the implied emphasis on continuous quality improvement, or CQI, as the organization constantly strives to meet that elusive ideal, always pushing for perfection. However, the significant disadvantage, and a common pitfall, is the potential for severe demotivation of employees. If standards are perceived as truly unattainable, even with extraordinary effort, workers can become discouraged rather than motivated, feeling like they're set up to fail, leading to burnout rather than breakthroughs. The second type is currently attainable standards. These represent costs that result from work performed by appropriately trained and experienced employees, but crucially, without requiring extraordinary effort. In contrast to ideal standards, provisions are made for normal spoilage and typical downtime, accounting for the realities of the workplace. These are designed to be more realistic. The key advantage here is that it fosters the perception that the standards are reasonable and, importantly, achievable. Employees are far more likely to buy into goals they believe they can actually reach, leading to higher engagement and sustained effort. The disadvantage, however, lies in the required use of judgment when setting these standards, which introduces the potential for manipulation. Managers might set standards a bit too loose to make their teams look good, or perhaps a little too tight to push them harder, which can lead to issues with accuracy and fairness over time. This raises an important question. What's the ultimate goal of your standard? Is it to inspire perfection, even if it's never quite reached? Or is it to create realistic, achievable goals that foster a sense of accomplishment and sustain motivation? The choice here has a very real, tangible impact on your team's morale and ultimately their performance.
That's a crucial distinction because it brings in the human element, doesn't it? It's not just about hitting numbers. It's about how those numbers affect the people doing the work and how those people feel about hitting those numbers. And that leads us to how these standards are actually set within an organization. There are primarily two broad approaches: authoritative and participative. First, authoritative standards. As the name suggests, these are set exclusively by management. It's a classic top-down approach. The advantages here are quite clear. Authoritative standards can be implemented very quickly, often streamlining the budgeting process significantly. Plus, because they're set by senior management, they're typically designed to include all relevant costs and considerations from a comprehensive company-wide perspective. However, there's a significant disadvantage, one that touches on human psychology. Workers might not readily accept standards that are simply imposed upon them without any input or understanding of the underlying rationale. This can easily lead to resistance, a lack of ownership, or even a feeling of disengagement. Then you have participative standards. This is where both managers and the individuals who are held accountable to those standards actively collaborate in setting them. It's a much more collaborative, bottom-up approach, fostering a sense of shared responsibility. The major advantage here is that workers are far more likely to accept and commit to standards they helped create. They feel a genuine sense of ownership and a deeper understanding of why those targets exist. The downside, though, is that participative standards are generally slower to implement. Reaching consensus among multiple parties takes time, requires robust discussions, and often involves negotiations to find common ground. But think about it in your own life as someone just tells you what to do versus you helping decide the best way forward. Which are you more likely to follow with genuine enthusiasm and dedication? This principle applies directly to business and how effectively standards are adopted and ultimately achieved. Okay, with those foundational policies and performance standards in place, we can now pivot to the comprehensive, overarching financial blueprint for an organization. The master budget. This isn't just a simple spreadsheet. It's the central hub where all the planning, all the strategic foresight truly comes together. It's also often known as the annual business plan, and it meticulously documents specific short-term operating performance goals, typically for a period of 1 year or less. Critically, this plan embraces both an operating or non-financial budget, which outlines things like units to be produced and sold, and a financial budget, which details the sources of funds and the specific plans for their expenditure. It truly is the entire interconnected picture of what the company aims to achieve financially in the coming year.
And what's truly fascinating here is how the master budget synthesizes all the different parts of a business into one cohesive financial narrative for the year. Its fundamental purpose is to provide comprehensive and coordinated budget guidance for an organization, ensuring that all departmental plans are perfectly consistent with the overall strategic objectives. It really is the ultimate coordination tool, making sure every moving part is aligned. Interestingly, master budgets go by several alternative names in the business world, such as static budgets, annual business plans, profit planning, or even targeting budgets. In terms of its components, a master budget generally comprises those operating budgets and financial budgets we just mentioned. It's important to note that it's prepared in anticipation of achieving a single level of sales volume for that specified period. This static nature is a key characteristic and also something we'll discuss as a limitation shortly. The ultimate output of this entire annual business plan process is a complete set of pro forma financial statements. This includes a projected balance sheet, a projected income statement, and a projected statement of cash flows. Essentially, what the company's financial results and position are expected to look like at the end of the budget period, all laid out before the year even begins.
So, while the master budget is this incredible, all-encompassing plan, it does have its limitations. The primary one is encapsulated right there in its alternative name. It's a static budget. It's confined to 1 year and, crucially, to a single anticipated level of activity or sales volume. This means that if actual results, say sales volume, deviate significantly from what was budgeted, the budgeted amounts for expenses and revenues might look very different from what actually occurs. Imagine you've perfectly budgeted for producing and selling 5,000 units, but then a new competitor enters the market, or your product suddenly becomes a viral sensation, and you end up selling 8,000 units. Your costs and revenues will obviously be much higher than your static budget projected, making a direct comparison to your original plan somewhat misleading. It doesn't tell you if you were efficient at the new level of activity. Another common pitfall is when an annual static budget is simply divided by 12 to establish monthly budgets. This can often wildly exaggerate variances, particularly in businesses with natural seasonal or volume fluctuations. For example, if you sell umbrellas, your summer sales will naturally be much lower than winter or rainy season sales. A static monthly budget might show huge unfavorable variances in the dry season and massive favorable variances in the wet season, simply because it doesn't account for that natural seasonality. It doesn't give you a true picture of efficiency or effectiveness at varying activity levels. And finally, while the reporting output, those pro forma financial statements are familiar and provide a grand summary, they might not always provide the most useful, granular information for day-to-day management decision-making. Managers often need more detailed, flexible insights than a single, fixed set of projected financials.
Right. Given those inherent limitations, it's absolutely essential to understand the intricate mechanics of how a master budget is constructed. Imagine this like a complex assembly line, where each budget is a critical station, building on the last, all designed to deliver the final product, a clear, integrated financial roadmap. It all starts at the very top with the organization's overarching mission and its strategic strategy. These high-level concepts then flow down into the more concrete, short-term objectives that will be pursued in the upcoming period. A crucial early step, and one that often informs the entire process, is the capital budget, which outlines long-term investments in assets like facilities and equipment. This often runs parallel to short-term planning, but informs the financial capacity for future operations. However, the absolute cornerstone of the master budget, the one that kicks off most of the operating plans, is the sales budget. From there, it branches into the other operating budgets, such as the production budget and the selling and administrative expense budget. The production budget, in turn, breaks down further into the detailed direct materials, direct labor, and factory overhead budgets. These three then feed directly into the cost of goods sold budget, which calculates the cost of the products that are manufactured and sold. All of these operating budgets, along with the capital budget, ultimately feed into the financial budgets, primarily the cash budget, which tracks the ebb and flow of money. And finally, all of this culminates in the creation of the pro forma financial statements, your projected income statement, balance sheet, and statement of cash flows. It's a meticulously interconnected system where a change in one area will inevitably ripple through the others, culminating in a complete and coherent financial projection.
Okay, now that we've seen the overall flow of the master budget, that grand assembly line, let's zoom in on its foundational building blocks, starting with the operating budgets. These budgets are established specifically to describe the resources that are needed for the day-to-day operations. And, just as importantly, the manner in which those resources will be acquired. They're all about the core activities of the business, the making, the selling, the general running of the show. Operating budgets typically include the sales budget, production budgets, selling and administrative budgets, and even personnel budgets. We'll be diving into a few of these in detail, starting with the most fundamental one, the one that truly kickstarts everything else.
Indeed, and it bears repeating. The sales budget is the absolute cornerstone of the entire budget process. It's the primary foundation upon which almost everything else is built. This budget represents the anticipated sales of the organization, quantified both in terms of units and in dollars. It is always the first budget prepared because its figures directly drive the development of most other components of the master budget. For instance, the number of sales units directly dictates the units required by the production budget. Simultaneously, the sales dollars from this budget directly inform the anticipated cash inflows and revenue figures that will appear on the financial statements. Furthermore, critical operational aspects like managing inventory levels, making decisions about future purchases, and even the planning of operating expenses are all closely coordinated and driven by the sales levels forecasted in this budget. If this budget is off, even slightly, it can throw the entire master budget out of alignment, creating inefficiencies down the line. It's a critical first domino.
So how do you actually build this crucial sales budget? It all starts with the sales forecast. This forecast isn't just pulled out of thin air or based on a gut feeling. It's a sophisticated process derived from input received from numerous organizational resources. You're talking about gathering rich insights from your sales staff, those on the ground who know the market dynamics and customer sentiment best. You're looking at robust statistical analysis, perhaps like the correlation between your historical sales and broader economic indicators or industry trends. And you're getting experienced opinions from line management who understand the operational realities and production capacities. A truly comprehensive sales forecast considers a wide range of factors. These include past patterns of sales, what have you sold historically, and what trends emerge from that data. It factors in Salesforce, estimates your team's direct frontline insights. It considers general economic conditions. Is the economy booming or showing signs of slowing down? You also have to keenly observe competitors' actions. What are they doing in the market and how might that impact your share? Changes in the firm's own prices, shifts in your product mix, the results of market research studies, and even your advertising and sales promotion plans all play a significant role. It's a holistic, multifaceted view that combines data, experience, and strategic intent.
Let's make this concrete with an example. Imagine Blancheford Stereo, a U.S. retailer, developing its sales budget for the upcoming year. Their sales manager knows sales are highly seasonal and significantly influenced by price and promotions. After careful analysis, they've identified different unit sales projections at various average selling prices across 4 quarters. They're facing a strategic choice. Go for higher profit margins with full retail prices or higher volume with discounts. Now, the requirement for them is to develop the sales budget, assuming the company has chosen a cost leadership strategy. This is key. It means they are intentionally opting for higher volume via lower prices to dominate the market share. So their decision is to go with the discounted higher volume projections. Instead of walking through every calculation, let's look at the strategic outcome. By choosing the discounted path, Blancheford projects a total sales budget of $1,090,000 for the year. This includes, for instance, a significant holiday spike in Q4, where they anticipate selling 10,000 units at a discounted price, generating $600,000 in that quarter alone. The key insight here is that your budget isn't just a financial forecast. It's a direct reflection of your business strategy. Aligning them is paramount. Blanche Forte's decision to pursue cost leadership meant sacrificing some per-unit profit for higher sales volume. And that strategic choice is immediately visible in their projected revenue numbers. It's a calculated projection based on market conditions and business strategy, not just a guess.
Okay, so once you know how much you expect to sell, the next logical question, and a truly fundamental one for any manufacturing or retail business, is how much do we need to make? And that's where the production budget comes in. This budget determines the precise number of units that need to be made, and it's prepared for each individual product or even each department within a larger organization, stated purely in units. This budget isn't just a simple unit count, though. It's a detailed breakdown that subsequently informs the amounts needed for direct labor, direct materials, and factory overhead, the core components of manufacturing. Crucially, the amount in the production budget is always based on two interdependent factors: the inventory you currently have on hand and the inventory you anticipate needing to sustain your future sales projections. It's all about expertly balancing supply with demand, ensuring you don't run out, but also don't overproduce.
Yeah, exactly. To establish those required levels of production, there's a fundamental formula that ties sales and inventory together. It's quite intuitive once you grasp the logic. You start with your budgeted sales for the period. To that, you add your desired ending inventory. This is that safety stock or buffer you want to have on hand at the end of the period to meet unexpected demand or ensure smooth operations into the very next period. Then, you subtract your beginning inventory, what you already have on hand at the start of the period. The result of this calculation is your budgeted production in units. Desired levels of inventory are normally a function of your anticipated sales volume. The goal is always to carefully balance the risk of running out of stock, which can lead to lost sales and unhappy customers, with the often significant cost of maintaining and storing excess inventory. It's a delicate balance to strike, as inventory ties up valuable cash.
Let's apply this with an example conceptually. Imagine Carlisle Manufacturing trying to estimate its production for June. They have a policy to maintain a safety stock and beginning inventory equal to 30% of their estimated sales for that month. Their estimated sales for June are 40,000 units, and for July, they're 30,000 units. Following their policy, Carlisle determines their desired ending inventory for June, which is July's beginning inventory, will be 9,000 units, and their actual beginning inventory for June is 12,000 units. Plugging these figures into our formula, they start with their budgeted sales for June, 40,000 units. They add their desired ending inventory, plus 9,000 units. Then they subtract their estimated beginning inventory, 12,000 units. That gives them a total budgeted production of 37,000 units for June. The key takeaway here is how a simple, seemingly small policy, like maintaining a 30% safety stock, directly and significantly impacts your production targets. It's not just a guideline, it's a critical input that drives operational decisions, ensuring you have enough product to sell without being swamped by excess inventory.
That example clearly highlights the mechanical calculation. But in the real world, several other practical factors can significantly affect the production budget. These include company policies regarding stable production. Some companies prioritize avoiding big swings in production levels to maintain steady employment and consistent equipment utilization, even if it means carrying more inventory at times. The condition of production equipment is also critical. You can only produce what your machines are truly capable of. The availability of productive resources, such as specific skilled labor or certain raw materials, can impose real constraints on what you can realistically produce. And finally, experience with production yields and quality understanding how much waste or defective product might occur during manufacturing also plays a crucial role in determining how many units you need to start to achieve your desired finished quantity. It's a dynamic puzzle.
Right. So once you know how much you need to produce, that naturally leads to the next step, figuring out what direct materials you need to buy and how much of those materials you'll actually use in production. That's where the direct materials budgets come into play. There are two critical but distinct components here: the direct materials purchases budget and the direct materials usage budget. Understanding the difference is key to managing your supply chain and cash flow.
Exactly. The direct materials purchases budget focuses specifically on the dollar amount of direct materials that you need to purchase from suppliers to sustain your production requirements. Conceptually, you calculate the number of units of material needed for your planned production, then adjust for your desired ending inventory of materials and subtract what you already have on hand. This tells you how many units of material you need to acquire. Then you multiply that quantity by the expected cost per unit to arrive at the total dollar amount of purchases. This budget is critical for managing your relationships with suppliers and forecasting your cash outflows for materials. Separate from this is the direct materials usage budget. This focuses on the cost of materials actually used in production during the period rather than what was purchased. The logic here is straightforward. You start with your beginning inventory of materials at their cost, add what you purchased during the period at their cost, and then subtract what you have left over in ending inventory at its cost. The result is the actual cost of materials that went into the products you manufactured. This is an important distinction because what you buy isn't always the same as what you use in a given period, especially if you carry inventory from one period to the next or if material prices change.
Let's go back to Carlisle Manufacturing to illustrate these direct materials budgets. Focusing on the outcomes rather than the step-by-step arithmetic, we know their budgeted production is 37,000 units for June, and each unit requires 4 pounds of direct material. They're navigating a scenario where new material costs $10 per pound, but some existing material was acquired at $9 per pound. They started June with 48,000 pounds and want to end with 36,000 pounds. After factoring in their production needs and inventory levels, Carlisle's direct materials purchases budget reveals they need to purchase 136,000 pounds of material, which translates to a total cost of $1,360,000 based on the current 10-pound cost for new purchases. For the direct materials usage budget, the cost of materials actually consumed in production, considering their starting inventory and new purchases, comes out to $1,432,000. The core insight here is that you must meticulously track both the physical units of material and their associated costs, especially when prices fluctuate. The direct materials purchases budget tells you what you need to spend to acquire materials, while the direct materials usage budget tells you the actual cost of materials consumed in your manufacturing process. Understanding both is crucial for accurate financial reporting and operational control.
Definitely. Following the direct materials, we move to the direct labor budget. This budget anticipates the hours and corresponding rates associated with the workers who are directly involved in meeting those production requirements. It's about knowing who's doing the work, how much time it will take, and what it costs in terms of wages. The formula for the direct labor budget is quite straightforward. You take your budgeted production in units. You multiply that by the hours or even fractions of hours required to produce each unit. This calculation gives you the total labor time needed for the period. Then you multiply that total number of hours needed by your hourly wage rate. The result is your total wages, which constitutes your direct labor budget. This budget is essential for planning your workforce, managing payroll, and ensuring you have the human resources available to meet your production goals.
Let's quickly apply that with Carlisle's numbers. We know their budgeted production is 37,000 units. The facts state that 2 hours of direct labor are needed per unit, and the hourly wage rate is $20 per hour. Based on these figures, Carlisle will need 74,000 total direct labor hours. Multiplying that by the $20 per hour rate results in a direct labor budget of $1,480,000. It seems simple, but it's incredibly important for planning your workforce and payroll efficiently, ensuring you have the right number of skilled hands at the right cost.
Next up is the factory overhead budget. This category includes all the fixed and variable production costs that are not direct labor or direct materials. Think of things like the electricity bill for the factory, the depreciation on the machinery, the rent for the production facility, or the salaries of supervisors who aren't directly assembling products but are essential to the manufacturing process. Factory overhead is then applied to the inventory, becoming part of the cost of goods manufactured and ultimately the cost of goods sold, based on some sort of representative activity, often called a cost driver. A cost driver is simply the activity that causes a cost to go up or down. Frequently, for factory overhead, this rate is applied using direct labor hours, because as direct labor hours go up, often so do many of these indirect costs, making it a reliable predictor.
Let's use Carlisle again for an example of variable overhead. The facts state that Carlisle Manufacturing uses direct labor hours to apply variable factory overhead, and has determined that its variable overhead rate is $5 per hour. From our direct labor budget, we know the company expects to use 74,000 direct labor hours. To compute the budgeted variable overhead for June, it's a simple multiplication. 74,000 direct labor hours multiplied by $5 per hour equals $370,000. It's a clear illustration of how variable costs directly scale with activity, giving you a predictable expense as your production ramps up or down.
Right. Now, we bring it all together with the cost of goods manufactured and sold budget. This is a pivotal budget because it accumulates all the information from the direct labor, direct material, and factory overhead budgets to calculate the total cost of what was made and ultimately what was sold during the period. It's the grand synthesis of your production efforts. First, let's define the components. The cost of goods manufactured, COGM, represents the total cost of all the products that were completed during the budget period. It's simply the sum of your direct labor costs, your direct material costs, and your factory overhead costs. Think of it as the all-in cost to get a product ready for sale. Then, to get to the cost of goods sold, COGS, which is what actually appears on your income statement and is matched against your sales revenue. You take your cost of goods manufactured. To that, you add your beginning finished goods inventory, those completed products you had on hand at the start of the period that are ready to be sold. And then, you subtract your ending finished goods inventory, the completed products still on hand at the end of the period that weren't sold. This formula ensures you're only counting the cost of what was actually sold to customers during that specific period.
Let's walk through the comprehensive outcomes for Carlisle using all the information we've gathered. We have direct materials used at $1,432,000, direct labor at $1,480,000, variable factory overhead at $370,000, and fixed factory overhead is given at $300,000. Also, the beginning finished goods inventory is in $1 million, and the ending finished goods inventory is $750,000. After combining these figures, Carlisle's cost of goods manufactured comes out to $3,582,000. This represents the total cost of everything Carlisle finished producing in June ready for sale, then taking that manufactured cost, adjusting for their beginning and ending finished goods inventory. Their cost of goods sold is determined to be $3,832,000.
This is where the magic happens. All those individual pieces come together to tell us the true cost of our products that were actually sold during the period. This budgeted cost of goods sold amount directly feeds into the pro forma income statement. It's matched with the budgeted sales revenue as a basis for determining the budgeted gross margin, a critical profitability measure that shows how much money is left from sales after accounting for the direct costs of making the product. It's a key indicator of a company's core operational efficiency.
Okay, lastly, for our operating budgets, we have the selling and administrative expense budget. This one covers all the non-manufacturing expenses anticipated during the budget period, and these can also be both fixed and variable. Think of everything involved in selling the product and running the general operations of the company, distinct from the direct process of making the product itself.
That's right. The components of these expenses are quite broad. Variable selling expenses are those that fluctuate directly with sales volume, such as sales commissions paid to your sales team, delivery expenses for products shipped, and even bad debt expenses, which might increase as more credit sales are made and some inevitably go uncollected. Then you have fixed selling expenses, which, as the name suggests, remain constant regardless of sales volume within a relevant range, like sales salaries for your management, consistent advertising budget that are set for a period, and depreciation on sales-related assets, like company vehicles or regional sales offices. Finally, there are general administrative expenses, which are typically all fixed. These encompass costs like administrative salaries for headquarters staff, the costs associated with accounting and data processing, depreciation on office equipment, and various other administrative overheads that keep the broader business running smoothly. It's important to note for the financial statements that these selling and administrative expenses are considered period costs. This means they are not inventoried as part of the product cost, like direct materials or labor. Instead, they are expensed in the period in which they are incurred, directly impacting the income statement for that specific period, reducing profitability for that time frame.
Right. We've talked about strategic plans, production, sales, and all the costs associated with making and selling a product. But none of that means anything if you don't have the actual cash to make it happen. So let's shift our focus to the lifeblood of any organization, the actual flow of money, cash coming in, cash going out. This brings us to the cash budgets. These represent detailed projections of cash receipts, money coming in, and cash disbursements, money going out. They are essentially derived from all those other budgets we've discussed, but with specific critical assumptions about when that cash actually flows. The cash budget is incredibly valuable because it provides management with crucial, forward-looking information regarding the precise availability of funds. This includes funds for distributing to owners, like dividends, for repaying debt obligations, and for making important new investments. It's the ultimate liquidity management tool. Generally, cash budgets are divided into three major sections: cash available, cash disbursements, and financing.
Okay, kicking off the cash budget, we first look at cash available. This section is normally associated with two main components: the cash balances available at the very beginning of the period, and the anticipated cash collections throughout the period. For cash balances, these are the amounts of cash a company literally has on hand that can be used to liquidate expenses. It's not always just a straightforward number. These balances might be limited by management policies, such as maintaining a minimum cash on hand, or by compensating balance agreements with banks, where a certain amount of cash must remain in the account as part of a lending agreement. Then we have cash collections. These budgets meticulously specify the amounts of cash that the organization expects to receive, primarily from sales, which ties back to our sales budget, and also from any anticipated loan proceeds. Cash collection budgets are meticulous. They set standards for collections based on current period sales, usually broken down monthly, and equally important, from prior period sales. This means you're not just looking at new sales, but also at money coming in from sales made last month or even the month before. Crucially, these budgets make specific assumptions regarding the percentage of credit sales versus immediate cash sales. And, for credit sales, the expected speed at which those collections are expected to occur. Are your customers typically paying in 30 days, 60 days? This directly impacts when that cash actually hits your bank account, which is vital for managing liquidity.
Let's look at an example to make this super clear. Imagine Betcon Inc., a U.S. retailer, creating its cash budget for September. They have historical data on how their credit sales are collected. 80% are collected in the next month after the sale, 18% are collected in the second month after the sale, and unfortunately, the remaining 2% are never collected. They have credit sales data for July, $850,000, August, $925,000, and September credit sales are forecasted at $700,000. Additionally, they anticipate $170,000 in September cash sales. After factoring in these collection patterns, Betcon's total cash collections for September come out to $1,063,000. The key takeaway here is a fundamental truth about cash flow. Past sales continue to significantly impact future cash flow, not just current sales. You can have a great sales month, but if your collection terms are long, that cash won't hit your bank account until later. This is why accurate forecasting of collections, not just sales, is so vital for maintaining liquidity.
Absolutely. Moving to the outflow side, cash disbursements budgets represent all the cash outlays associated with purchases and with various operating expenses. This tells you exactly how much cash you'll need to pay out and when. For purchases, these budgets indicate the precise amount that is expected to be paid for direct material purchases or any other type of purchase the company makes. This includes cash purchases made in the current period, payments for credit purchases, accounts payable, made in the current period, and crucially, cash disbursements required to pay off accounts payable from prior periods during the current month. These budgets are developed by carefully considering the percentage of goods bought on credit, the typical payment terms, or age of payables that are liquidated, and the percentage of goods purchased for cash versus on credit. For operating expenses, these cash disbursements budgets specify the amounts paid out to cover the costs of running the business. A very important point here, and one that often trips people up, is that these budgets eliminate non-cash operating expenses such as depreciation.
Depreciation is an accounting entry that reflects the wearing out of an asset over time, but no actual cash leaves the company when depreciation is recorded. So while it's on the income statement, it's removed for the cash budget because we're only tracking actual money movement. These budgets include prior month expenses that will be paid in the current month, any current month expenses for which disbursement is deferred until the following month, and of course current month expenses that are paid in cash immediately. They also considered the effect of accounts payable related to other operating expenses and accrued payroll.
Okay, let's continue with Betcon Inc. and look at their September cash disbursements. They've categorized their outflows for the month. $425,000 for direct materials, $310,000 for direct labor, $150,000 for overhead costs, $145,000 for operating expenses, $120,000 for capital expenditures, and $35,000 for dividends. Adding up all these anticipated cash outflows, Betcon's total cash disbursements for September amount to $1,185,000. It's interesting how often people assume depreciation is a cash expense, but it's a key distinction to remember in budgeting. Understanding what's truly a cash outflow versus an accounting entry is vital for an accurate cash budget.
It really is. The third major section of the cash budget is financing. This part considers how an organization will manage its overall cash levels, often through borrowing or investing. It addresses critical questions like, how will operating financing, such as drawing on a line of credit, be strategically used to maintain minimum cash balances and avoid a liquidity crisis? Or, conversely, if there's an excess or idle cash, how will it be wisely invested to ensure both liquidity, meaning it can be quickly accessed if needed and adequate returns rather than sitting idly? To illustrate, our Betcon example forecasts a beginning cash balance for September 1st of $80,000. The company's policy is to ensure that its ending cash balance is at least $50,000. After calculating its collections and disbursements, it determines it will have a deficit of $42,000 before financing. To bridge this gap and meet its policy, it plans to borrow $95,000 at the end of September from its established line of credit. Crucially for September's budget, the first interest payment on this borrowing would not be due until October 31st, so it doesn't impact September's cash disbursements. This kind of proactive planning, thanks to the cash budget, allows a company to foresee and avoid a potential cash crunch before it happens.
Right. So, tying it all together, cash budgets are essentially formal statements of planned cash receipts and disbursements. They are primarily affected by the amounts that are also used in the budgeted income statement, but with that critical distinction of only including cash movements. Let's look at Becon's combined cash budget for September, focusing on the ultimate insight. They started the month with $80,000 in cash. After factoring in their projected cash collections of $1,063,000 and their cash payments of $1,185,000, they would actually end the month with a negative cash balance of $42,000 before any financing activities. This is a red flag. But because they proactively used the cash budget to identify this potential shortfall, they can plan for it. By strategically borrowing $95,000, they managed to cover that deficit and end the month with a healthy cash balance of $53,000, successfully meeting their policy.
Exactly. This clearly illustrates the power of the cash budget. It can reveal potential shortages before they become a critical problem, allowing a company to proactively plan for financing or adjust operations. It's a vital tool for ensuring continuous liquidity and avoiding unexpected crises. Beyond the cash budget, the culmination of all budgeting efforts results in the pro forma financial statements. These are essentially your projected financial statements, created from all the detailed budgets we've just discussed. They are the grand summary, the forecast of the company's financial health. The pro forma income statement pulls its key components directly from the operating budgets. This includes the budgeted sales from your sales budget, the cost of goods sold derived from your production budgets, the selling and administrative expense budget, and any interest expense budget, which will be taken from the cash budget's financing section. This statement projects your anticipated profitability. The pro forma balance sheet then displays the balances of each balance sheet account, adjusted in a manner consistent with the income statement and cash budget plans. Balance sheet accounts are adjusted for the cash collections and disbursements determined in the cash budget, as well as for non-cash transactions that were accounted for in the income statement, like depreciation. This gives you a projected snapshot of your assets, liabilities, and equity at a future point in time. And finally, the pro forma statement of cash flows is derived from the budgeted income statement and both the current and previous budgeted balance sheets, and then reconciled back to the cash budget itself. This statement is incredibly beneficial because it displays the actual cash effects of the entire master budget on projected cash flows. It assists management in determining whether additional sources of financing will be required, and it helps in evaluating the optimal use of trade credit, how effectively you're managing payments to suppliers and collections from customers. These statements, taken together, offer a holistic, forward-looking view of the company's entire financial health before the year even begins, serving as a comprehensive financial compass.
Okay, so far we've focused heavily on those short-term, typically one-year operating and financial budgets. But businesses also have to plan for the very long haul for investments that will shape their future for decades. And that transitions us into capital budgets. These budgets are all about identifying and evaluating those significant, often multi-year capital additions. We're talking about major investments in facilities, purchasing brand new equipment, the development of entirely new products that might take years to launch, or other long-term strategic investments that require substantial financial commitment and will define the company's trajectory.
That's right. This is precisely where a company places its biggest bets on the future, making long-term investments that will shape its direction, its capacity, and its competitive position for many years. Financing is a particularly significant component of the capital budget. These projects almost always require substantial upfront cash or access to significant credit, making them highly dependent on the availability of funds. A company might have to decide whether to invest in a new, automated factory that costs hundreds of millions, or acquire a smaller competitor to gain market share, or pour resources into developing a revolutionary new technology. These aren't minor decisions. Furthermore, capital budgets generally involve very long-term commitments by the organization. Once you invest in that new factory or a major piece of machinery, you're committed to that asset, its associated costs, and its impact on your operations for many years to come. This makes capital budgeting a critical, forward-looking exercise that has profound implications for a company's long-term success, its ability to innovate, and its overall sustainability. It's about building the future, not just managing the present.
Makes sense. Now let's talk about something that makes budgets much more dynamic and useful when reality doesn't perfectly align with the plan. Flexible budgeting. Unlike the static master budget we discussed, which assumes a single fixed level of activity, a flexible budget is a financial plan that's specifically designed to adjust for changes in production or sales volume. It accurately reflects expected costs for the adjusted output, meaning it can predict financial outcomes and accommodate shifts in actual activity. Revenues and expenses within a flexible budget aren't fixed. They're designed to adjust to display anticipated levels for the outputs actually achieved. It's like having a map that redraws itself in real time as you change your destination or encounter unexpected detours.
Exactly. And for flexible budgets to work effectively, they rely on some key assumptions. They specifically include consideration of revenue per unit, how variable costs behave per unit, and how fixed costs behave over a relevant range. The relevant range is a crucial concept here. It defines the activity level or volume range within which the relationship between revenues and variable costs will remain largely unchanged, and importantly, within which your fixed costs will remain stable. Stepping outside this range means your cost behavior might fundamentally change, and the flexible budget would no longer be an accurate predictive tool. In terms of benefits, flexible budgets are incredibly powerful because they can display financial outcomes at different volume levels within that relevant range. This allows management to pinpoint areas where efficiencies have truly been achieved, or conversely, where waste has occurred, even if the actual activity level differs significantly from the original plan. It provides a much fairer and more insightful basis for performance evaluation, as you're comparing apples to apples, adjusted for volume. However, flexible budgets do have limitations. They're highly dependent on the accurate identification of fixed and variable costs. If you misclassify a cost as fixed when it's actually variable, or vice versa, your flexible budget will be inaccurate and lead to faulty conclusions. And as mentioned, the accurate determination of that relevant range is also critical for its effectiveness.
Let's bring this to life with an example. Meet Flexomatic Corp., producers of the Flexomatic exercise equipment. Their corporate controller is developing a flexible budget. Their master budget anticipated an output of 5,000 units. Their relevant range extends 20% above and below that master budget, so between 4,000 and 6,000 units. We know their selling price is $60 per unit, variable costs are $40 per unit, and fixed costs are $100,000. Now, instead of walking through all the numbers, let's look at the powerful insights this flexible budget provides at different activity levels. At their master budget level, 100% activity, 5,000 units. Fleximatic projects sales of $300,000, variable cost of $200,000, and fixed costs of $100,000. This leaves them with an operating income of $0, meaning they break even at their originally planned volume. Now, if they only achieve 80% of their master budget, 4,000 units, the flexible budget shows sales dropping to $240,000 and variable cost to $160,000. Crucially, their fixed costs remain at $100,000. This results in an operating loss of $20,000. Without a flexible budget, simply comparing actual results at 4,000 units to a static 5,000 unit budget might falsely accuse the team of poor performance, when in reality the loss is directly attributable to the lower volume. Conversely, if they perform exceptionally well and hit 120% of their master budget, 6,000 units, the flexible budget projects sales of $360,000, variable costs of $240,000, and those same fixed costs of $100,000. Here, they achieve a healthy operating profit of $20,000. This is truly powerful, right? It shows that even if your sales volume changes, you can still accurately estimate your profitability because your costs flex with it, providing a much clearer and fairer picture of performance than a rigid static budget ever could.
Absolutely. What this fascinating example demonstrates is the critical importance of understanding your cost behavior, specifically differentiating between fixed versus variable costs, for effective planning and, just as importantly, for accurate performance evaluation. Without that clear distinction, a static budget might falsely indicate poor performance at lower volumes or exceptional performance at higher volumes, when in reality the company is simply operating as expected for that activity level. It moves budgeting from a rigid forecast to a dynamic tool for understanding financial performance in a constantly changing environment. #outro.
Wow, what an incredible journey we've taken through the comprehensive world of budgeting. We've gone from understanding how budgeting bridges grand strategy to daily operations, to the policies and standards that lay the groundwork, to the intricate details of master budgets with their sales, production, and cost components. We then navigated the crucial, life-giving flow of cash and wrapped up with the forward-looking capital budgets and the dynamic adaptability of flexible budgets. So what does this all mean for you? We've reinforced the idea that budgeting is far from a static, dry, number crunching exercise. It's a dynamic, essential tool, the very financial heartbeat of an organization. It truly acts as a shortcut to being incredibly well informed about an organization's internal operations and its financial health. Every single component we discussed, from a single sales forecast unit to the careful management of direct materials, all the way up to a company's overall profitability and cash position, is deeply interconnected. It's a living, breathing system that gives you foresight into the financial future, allowing you to anticipate challenges and seize opportunities.
Right. And this raises an important question for you to consider.
Yeah.
If budgeting is fundamentally about planning and control, forecasting what's to come, and then measuring against it, how might understanding these sophisticated principles apply not just to a large corporation like the ones we've discussed, but to your own personal financial goals? Or perhaps to managing a complex project with limited resources, whether at work or in your community? Next time you encounter any budget, whether it's for a multi-million-dollar company or your next vacation, I encourage you to think about the why behind it, the strategic choices embedded within its numbers, and how those choices are designed to achieve foresight and control over resources. You'll find these core concepts are universally applicable to achieving your objectives.